Hey man, thanks for getting back to me. Thanks for the kind words on the email and appreciating the video that we put together. I do agree, this is fascinating. You had asked the question though about something about $60,000 a year would make more sense to start, and not sure if we could increase that over time or if we would have to create an entirely new policy to go that route. And could I let you know? Yeah, so let me kind of go through this with you right now. Let me walk through where we began the design for you and where we've kind of redesigned it so that makes more sense. But let me kind of reset the stage. Remember, columns 3, 4, 5, and 6 are life insurance policy information. Columns 8, 9, 10, 11, 12, 13 are bank lending information. Column 14 is the math between the policy and the outstanding loan balance. So where we initially started for a 42-year-old, we started at $20 million death benefit, and max premiums for a 42-year-old for 20 million is $1.2 million a year. And because of that 1.2, remember, we're going to have a bank finance those premiums. We're going to borrow those premiums, $1.2 million a year. No personal guarantee, non-recourse lending from one of our private banks here. So $1.2 million a year. We're also going to finance the interest. So the bank is going to charge interest and we're going to roll that into the loan as well. But we have you making a payment of 10% of the premium amount. 1.229 is the premium. We show you paying 10% of that, $123,000 out of pocket every year. And so because of the premiums that they're lending, the interest that they're lending, minus the payment that you're making out of pocket, leaves us an end of the year loan balance. And this is the part that's no personal guarantee, non-recourse. And that end of the year loan balance in year one is $1.1 million. Well, the cash value in year one, the portion of the policy that the bank is able to take as collateral, is $318,000. 1.1 minus 318 leaves us $856,000 of a gap, and that needs to be made up by you in the form of cash equivalents, marketable securities, or most likely some type of letter of credit against a bank, collateralizing hard assets, real estate, things like that. And when we wash, rinse, repeat the design of what we're doing here, and we're illustrating a 6.2 static rate of return, the reality is this account has earned much higher than 6.2% over the last 10 to 15 years, probably closer to 9.5%. And we expect interest rates for the next 12 to 18 months probably go down as well. But we're illustrating a 1.7% difference. So the difference between the 6.2% and the static 4.5% bar, we're illustrating the difference between that as arbitrage, 1.7% in this design. See if I can get my cursor to work. 1.7%, there you go, in this design. And with that differential, collateral goes from 856 up to 900 up to 906. So increased by $44,000, increased by $6,000, and then goes down by, what is that? $26,000, goes down by another $59,000, goes down. And then ultimately it disappears in year 8. And the reason why it disappears in year 8 going forward is because the cash surrender value of the policy, remember that's the portion that the bank can take as collateral, is now bigger than the outstanding loan balance. But your question was, what does it look like if we cut it in half, and are we able to add to it later? And when we redesign it for a maximum efficient design where $60,000 a year is your out-of-pocket payment, to make the most efficient design, we had to just basically cut everything in half. So instead of 20, it's 10. Instead of 1.2, it's 600 of the premium payment. Everything across the board, the size of the policy, the size of the bank financing, the size of the collateral, everything is cut in half, even down to your tax-free distribution, which was $680,000 a year, is now $340,000 a year. Still income tax-free, still a really good design. So the question you just have to ask is, is this where you want to start? Is this where you want to finish? However, I would say that if you do anticipate increasing over time, you don't have to, but if you do anticipate increasing over time, the best move would probably be to lock in the $10 million permanent policy today, and then maybe do a $10 million term policy as well, which would be about, again, $8,500 if everything's cut in half for 10 years, that we could convert to a bigger policy down the road. And we can convert either a portion of that 10 million or we can convert all of that 10 million. So something to think about, something to consider. But man, if I go back to even still what this looks like, $60,000 a year out of pocket. So you're paying $600,000 over 10 years. And at the end of the second year of taking distributions, you would have gotten all of your $600,000 back. And now every $340,000 distribution plus the millions of dollars of tax-free death benefit is all money that you've created using the arbitrage and leverage in this design. And it all comes back to collateral. How comfortable are you pledging that collateral for an extended period of time? Maybe it extends a little bit longer than this design. Maybe it's a little bit shorter. It just all depends on how the performance of the policy works and where we're at with the arbitrage. Hope this is what you were looking for. Look forward to talking to you soon.